10 outlooks. The world's top asset managers, one podcast. This is an AI versus AI showdown, guided by a former top-tier senior portfolio manager. And we've done the deep dive for you. What if the US is losing its growth edge? What if China's stealth stimulus and AI leap reshapes global power? US GDP is slipping, tariffs are exploding, and OBA could quietly blow a $5 trillion hole in the US deficit. Europe is making its boldest fiscal reset in decades, channeling Draghi's whatever it takes. We unpack the top 5 macro risks for the rest of 2025 and show you how to position across equities, bonds, gold, and global alternatives before markets reprice. This isn't clickbait. It's a razor-sharp synthesis of the world's smartest CIOs, debated by AI, filtered by human experience. Don't fall behind. This 18-minute deep dive could change how you invest for the rest of the year.
Today we're cutting through all the noise, really drilling down into the H2 2025 outlook for global markets. You sent us a huge stack of the latest street insights, major CIO reports, in-depth investment themes, and our mission is simple. Extract the absolute core of what you need to know. We're talking tariffs, central bank moves, and some pretty surprising shifts happening in economies all around the world. Our goal is to give you that crystal clear insight, that aha moment that helps you feel fully informed and, frankly, ready to navigate whatever's coming next.
Exactly. And the global economic political landscape is definitely undergoing a significant reordering. Think of trade relations, political alliances, it's all shifting. And that really drove a lot of market uncertainty in the first half of 2025. Now, precise estimates for things like, say, tariff levels or exactly when interest rates will change, those remain fluid, of course. But the sources you've gathered show some pretty clear directions of travel for key trends in markets. So this deep dive, it's going to synthesize these perspectives, give you a concise but hopefully comprehensive view.
All right, let's unpack this then, starting with the U.S. I mean, for years, it's been the standout for growth, right? But forecasts have seen a notable decline since January. What's really driving this anticipated slowdown?
Yeah, we're seeing expectations for U.S. real GDP growth slowing pretty significantly. Think nearly 3% in 2023-24, down towards maybe 1.6% in 2025. A lot of this is due to weakened private demand, Higher tariffs push up prices, and that dampens consumer sentiment. Plus, businesses get hesitant, too.
And the tariffs themselves. I mean, that story just keeps going. What's the latest read on that? What are the projections looking like?
Well, current projections anticipate the U.S. effective tariff rate settling somewhere near 15%.
15%? Wow.
Yeah, it's a big jump from around 3% last year. And for China specifically, that rate could be even higher, maybe 30, even 40%. Now, this will likely slow U.S. growth and probably lift inflation a bit, but it's generally not expected to cause an actual recession. There are underlying strengths: high household net worth, relatively low household and corporate debt. Those help cushion the blow.
That's a really crucial distinction, isn't it? Pushes back against some maybe overly dramatic headlines.
Yeah.
What about fiscal policy, especially with this One Big Beautiful Bill Act, the OBBA, that's making waves?
Oh, yes, the OBBA. The Senate is expected to pass it. Essentially, it extends those 2017 personal income tax cuts, increases state and local tax deductions. The SALT cap raises defense spending, but reduces some Medicare outlays.
Okay, so a mixed bag fiscally.
Right. And while some hope it might support markets, the big concern is the deficit. Projections suggest it could increase the federal deficit by, get this, $3 to $5 trillion over the next decade.
Oh, wow.
So that immediately raises flags about, well, how do you finance that borrowing, and what does it mean for longer-term Treasury yields?
And the Fed,
Yeah.
They've been holding rates steady, right? Citing sticky inflation, solid growth. But are rate cuts still really on the table? What's the consensus view?
Well, the Fed has kept rates steady, that's true. But the expectation is still for them to deliver maybe another 100 basis points of easing this cycle.
A full percentage point.
A full percentage point, yeah. With cuts likely resuming maybe in September, as growth does start to show signs of slowing. And that shift, from holding to potentially easing again, that could have some meaningful effects on U.S. markets.
Okay, so that leads to this whole debate about the end of U.S. exceptionalism.
Yeah.
What are the sources saying about the U.S. dollar and its role globally? This feels bigger than just a temporary dip.
It does feel like a deeper reassessment. The U.S. dollar's had an amazing run, maybe 15 years or so, and it looks pretty rich right now on a real trade-weighted basis. So forecasts do suggest further USD weakness in the second half of this year.
Why? What are the drivers?
Several things. Slower relative U.S. growth compared to elsewhere, lower U.S. interest rates eventually, and, this is key, a real reevaluation by global investors. They're looking at its role, questioning its dominance as the reserve currency. And that stems from U.S. fiscal challenges, the policy uncertainty we talked about, and maybe a diminished view of the dollar and treasuries as the ultimate safe havens. Some investors are definitely asking, should we trim back our U.S. exposure?
So putting that all together, what does it mean for U.S. equities? Especially after the incredible performance we've seen. Are the opportunities shifting?
Well, after that impressive run, U.S. equities, especially those mega-cap names, they do look particularly exposed. Valuations are elevated.
Go ahead.
Opportunities might still be there in tech, healthcare, financials, perhaps, but the general recommendation seems to be a shift towards more diversified global stocks. Move away from that heavy U.S. concentration. I mean, the U.S. is over 64% of the MSCI All-Country World Index right now. That's a very concentrated bet.
Right. A huge chunk. Okay, let's pivot to Europe.
Okay.
Can Europe escape the direct impact of these trade tensions? Or are they caught in the middle?
Well, direct European exports to the U.S. are only about 3% of European GDP.
Okay, not massive directly.
Not massive directly. So tariffs are a headwind, yes, but maybe a limited one in that sense. What's more interesting, perhaps, is Europe's own proactive response. They've adopted some pretty pro-growth policies. We're seeing historic increases in fiscal spending. Germany, for example, lifted its debt brake restrictions.
That's a big deal.
Huge deal. And committed to much greater defense and infrastructure, spending nearly 2.5% of its 2024 GDP. That's a strategic move.
And this is where it gets really interesting. That comment from German Chancellor Friedrich Merz, echoing Mario Draghi's famous doing whatever it takes. That carries a lot of weight, doesn't it?
It absolutely does, that kind of commitment, especially focused on defense and infrastructure. Plus, you have European firms actually quite well placed to supply modern defense equipment. It suggests potentially positive fiscal multipliers for Europe, so government spending generating even more economic activity. And on top of that, the European consumer seems to be starting to spend a bit more, save a bit less. That's also supportive.
And the European Central Bank, the ECB, they've already cut rates. What's next for them?
Yeah, the ECB actually led this cutting cycle, which helped push borrowing costs down, boost loan demand a bit. They did signal a pause in June, but the expectation is for at least one more rate cut from them, so continued support there.
So given all that, the fiscal push, the ECB easing, the consumer may be waking up, how should investors think about Europe?
Well, Europe might see less aggregate upside than, say, the U.S. or emerging markets overall, but there's definitely value seen in quality stocks, maybe Swiss high-quality dividends, and specific themes like European defense spending, that strategic autonomy push we mentioned. Plus, the EU seems to be amplifying its trade relations elsewhere, gaining momentum towards, single market integration, financial market integration. That could actually make the euro more attractive globally down the line.
Okay, interesting. Now, quickly across the channel to the UK, what's the picture there? Similar dynamics?
The Bank of England is also expected to deliver at least one more rate cut. However, the UK, a bit like the US and maybe Japan, faces greater fiscal and inflation uncertainties. So that could mean higher long-term bond yields there compared to some other places. It's a slightly trickier path for the UK.
Got it. All right, let's turn to Asia, Japan first. They've been a focus for a while with corporate reforms. Is that momentum continuing?
Yes, Japan continues to shine, really, among international equity markets. A lot of that is down to the positive momentum on corporate governance reforms. That's a huge story investors are following.
Right.
Plus, you've got steady progress towards, healthier inflation levels and better domestic consumption. That should also support the stock market.
But Japan's so export-driven. How vulnerable are they to potential U.S. tariffs?
They are particularly sensitive, yes. It's a key risk for them.
Yeah.
However, it seems they're highly motivated to negotiate with the U.S. administration, try to get those tariffs lowered.
Okay.
From an investment angle, high dividend equities in Japan seem to be favored right now. They offer some attractive yield.
All right, now let's talk China. Their policy has shifted quite significantly towards stimulus lately. What impact are we actually seeing from that?
Yeah, China's policy has definitely turned more stimulative. You see it in their 2025 budget. They're really aiming to support consumption and, crucially, high-tech development. Measures like that recent appliances trade-in program or issuing those ultra-long-term government bonds.
Right, I saw that.
They seem to have yielded some favorable results. We saw positive surprises in economic data like better auto sales, decent consumer spending during May's Golden Week holiday.
And what about China's tech sector and its AI ambitions? We hear so much about U.S. AI dominance, but is that story maybe changing faster than we think?
This is, I think, a really fascinating development because AI has largely been seen as a U.S.-led story, especially since ChatGPT burst onto the scene.
Definitely.
But January 2025 seemed to mark a real shift. You had DeepSeek, this Chinese startup, really challenging assumptions about who's leading in AI. And since then, several Chinese tech giants have announced their own competitive AI models. So that's making Chinese tech stocks look increasingly attractive, especially when you factor in supportive domestic policy there and maybe some flagging enthusiasm for the really high valuations in U.S. tech. And importantly, valuations in China's info-tech sector still look reasonably priced compared to the U.S. equivalents.
Okay, that's a key point on valuation.
Yeah.
How do the ongoing trade tensions factor into China's outlook, though? That's always the elephant in the room.
It is. Chinese policymakers have clearly signaled they want to support growth, and frankly, they want Chinese stocks to move higher, partly in light of the trade war. So while U.S. tariffs will likely remain a drag on overall global growth, China's stimulus measures should help maintain its own growth trend, even with the known issues like debt loads and some deflationary pressures. Also, the expectation is the Chinese yuan, the CNY, will likely remain strong. Devaluation could really hit some crucial deals they're trying to build with other economic blocs.
Right, they need that stability.
Yeah.
Okay, so moving beyond the regional pictures, what specific events should investors really have circled on their calendars in the coming months? What should we be watching closely?
Yeah, several key things to keep an eye on. In the U.S., that budget reconciliation process, the OBBA bill, that's unlikely to be fully sorted until late summer. So continued uncertainty around spending and taxes there.
Okay.
Elsewhere, look at Brazil. Their central bank is probably done hiking rates at 14.75%. They might start unwinding those early next year, but only if the fiscal situation holds up. Mexico's central bank, meanwhile, is already loosening. In China, that front-loaded fiscal spending we mentioned is starting to wind down. We might see a mild policy rate cut in the second half, but that could also reveal some weak spots, maybe deflationary pressures resurfacing or renewed weakness in housing prices.
Right.
And finally, the oil market. Keep a close eye there. OPEC Plus seems to be bringing supply back online faster than expected. That could potentially lead to oil prices dropping in the second half.
We have lots of moving parts globally. So let's try to distill this. Given all these dynamics, all these upcoming events, what are the absolute crucial risks investors need to monitor as we go through H2 2025? Let's hit the top 5.
Okay, we've boiled it down to 5 key risks for you to really focus on. First, just persistent uncertainty and volatility. This global reordering of trade, of alliances. It caused uncertainty metrics to just soar in the first half of 2025, and the expectation is they stay high, driving above average volatility. U.S. policy, especially tariffs, is a primary driver.
Yeah, uncertainty is kind of the baseline now.
It really seems to be. Second risk, U.S. fiscal policy and debt sustainability. That already high fiscal deficit looks set to widen further with tax cuts. That could increase funding costs, raise fears about sustainability. I mean, think about it. Roughly $8 trillion of U.S. government bonds, coupon securities, are maturing by the end of 2027.
$8 trillion. That's staggering.
It is. And that could put real upward pressure on U.S. Treasury yields.
Okay, risk number 3.
Number 3. Inflation and interest rate trajectories. Tariffs are a pretty clear source of, one-time cost push inflation. And while the Fed is expected to cut rates eventually, if inflation stays stickier than expected, that could delay the easing. So higher long-term bond yields remain a significant risk, particularly in the U.S., the U.K., Japan, places with those greater fiscal and inflation uncertainties.
Got it. 4th risk.
4th, U.S. dollar weakness. We expect the dollar's recent weakness to probably persist. Why? Slower relative U.S. growth, the prospect of lower U.S. rates, its current, frankly, overvaluation, and that continued reassessment by global investors of its reserve role, driven by those fiscal issues and policy uncertainty.
So a potential shift away from the dollar.
A potential widespread reallocation away from U.S. assets, yeah. That could cause further dollar weakening and also push Treasury yields higher. It's interconnected.
Okay, and the 5th key risk.
Finally, number 5. Geopolitical tail risks and trade war impacts. Look, there's a fragile ceasefire between Iran and Israel, but no real resolution in sight for Russia-Ukraine. These situations are just inherently unpredictable.
Always a background worry.
Exactly. Investors need to stay alert to potential escalations. And relatedly, just the persistent uncertainty about tariff levels, due to complex trade negotiations that could dent global growth, even if we probably avoid a full-blown global recession.
Okay, so those are the big 5 risks to watch. With all this in mind, the regional outlooks, the risks, how should you actually be thinking about positioning your portfolio for the rest of 2025? What's the actionable takeaway here?
Yeah, the overarching message really coming through from all the sources is the critical importance of diversification. And true diversification, not just across asset classes, but really importantly, across geography.
Geographic diversification. Okay.
Yes. And that includes maintaining positions in things like cash, gold. Gold remains an effective hedge against geopolitical risk. And interestingly, central banks have been buying it up at a record pace recently. And also consider other uncorrelated assets like alternatives, think hedge funds, private credit, real estate, infrastructure, things that don't necessarily move in lockstep with stocks and bonds.
So it's definitely not just about broad market index investing anymore. You're saying it's about making smarter, more targeted choices within those asset classes. Where are the specific opportunities emerging from this global reshuffle?
Precisely. For equities, look, expected returns globally might be pretty modest by year-end, so investors might want to consider gradually increasing exposure to diversified global stocks, maybe on a currency-hedged basis if you're a non-U.S. investor.
Okay.
And sector selection becomes really paramount, favoring maybe domestic-focused sectors, service-oriented sectors, things less directly hit by tariffs.
Makes sense.
And we're also seeing compelling opportunities highlighted in what you might call transformational innovation themes. Think AI, but across the whole stack. Infrastructure, semiconductors, applications. Also, power and resources driven by just surging electricity demand from AI and EVs. And longevity, things like pharma, medtech, wellness, senior housing. These are areas where these big economic shifts are creating long-term tailwinds.
That's fascinating. And what about income? For investors seeking income, especially as interest rates might be plateauing or starting to fall in some places, where can they find durable yield?
Yeah, that's key. With lower rates potentially on the horizon globally, seeking durable income is crucial. Opportunities exist in high-grade and investment-grade bonds, definitely. Also, diversified fixed income strategies, including private credit, which offers different risk-return profiles, and maybe equity income strategies.
Right.
And here's an interesting one. For dollar investors, hedging the currency risk in, say, Japanese yen bonds or Chinese RMB bonds can actually provide quite attractive carry right now, offering total yields that might look better than traditional dollar fixed income.
That makes a lot of sense.
Yeah.
It really sounds like being proactive, staying disciplined is absolutely critical in this kind of environment where things can change so fast.
It truly is. Using professional management approaches, things like phased investing, dollar cost averaging, and regular rebalancing, these are crucial for anchoring your portfolio to a disciplined plan. It helps you avoid making costly mistakes based on emotional reactions to market swings,
Right.
And it keeps you positioned to actually capture opportunities as conditions inevitably change, sometimes very quickly.
Okay. Well, that was a truly comprehensive deep dive into the H2 2025 outlook. We covered a huge amount of ground-specific regional insights for the U.S., Europe, U.K., Japan, China, plus those critical upcoming events and the top 5 risks that are definitely going to shape markets for the rest of the year.
Yeah, and the takeaway for you listening is pretty clear, I think. While uncertainty is basically a constant these days, understanding the direction of these key trends and implementing disciplined, well-diversified investment strategies, that can really help you navigate this environment effectively. And maybe even find some new avenues for growth.
Absolutely. This deep dive really highlights how the global economy isn't just reacting passively to policy changes, it feels like it's actively rewiring itself. So here's a final thought for you to chew on. If the U.S. dollar's long dominance is indeed being fundamentally reassessed by global investors, how might the landscape of global reserve currencies evolve beyond 2025? And what new opportunities might that create for savvy market participants who are ready to adapt to what could be a really profound shift? Thank you for joining us for this deep dive. Until next time, stay curious, stay informed, and keep digging for those insights.
You've just heard the sharpest insights from 10 of the world's leading asset managers, analyzed, distilled, and debated in our unique AI versus AI format under the supervision of a former senior portfolio manager from top-tier institutions. We unpacked GDP risks, tariffs, global policy shifts, and how to position for what's coming in H2 2025. If that gave you clarity or sparked new questions, help others find it too. Like this episode, Share it with a colleague and subscribe for more global macro deep dives every week. Stay informed, stay sharp, stay one step ahead.